All right, good morning, folks. This is Dave Newell from FAIA. Welcome to another edition of Friday Morning Live. Today's date is March 20th, 2020. I hope everybody is doing well, dealing with a lot of disruption in your personal and business life. But we appreciate your time this morning on this very important subject, for being with us, whether you're attending this webinar at your home or certainly in the office. So thank you so much. Just a couple housekeeping items that we always advise those folks attending Friday Morning Live. The first thing is we encourage questions, and we will try to answer as many questions during the broadcast as we can, but understand we try to keep the presentation to about an hour. So if we can't get to all the questions, what we always do is we will get the questions answered and then post it for everybody to see. The other thing that we're doing this morning, because we have awesome special guests from AM Best with us, we are recording this for future use. So if just in case you have to jump off or you want to share it with some of your colleagues, we're going to have that available to our members. And then lastly, before I turn it over to Jeff Grady, our president and CEO here at FAIA, anything that we can do to help you with issues that you're experiencing in your office or any questions we can answer. We have a lot of resources on the website for the coronavirus, so certainly reach out to us. You have your member advocates that you can also utilize those during this time, but we encourage you to certainly pay attention to our blogs, pay attention to the resources on our homepage, and we're here to help. So with that being said, I want to welcome Jeff Grady, our president and CEO of FAI, to open up the conversation today about the Florida marketplace. Jeff, take it away.
Thanks. Thanks, everyone, and good morning. As Dave said, is fully functional, working remotely, and we are able and are capable of taking your calls or inquiries, and we're taking a lot of those right now. Hope you all are doing well. The experiences that you are encountering are being relayed to us, and we are relaying those to public officials. So thanks for hanging in there. We had this Florida market update scheduled several weeks before the epidemic took place, and it's still very timely given what was going on in the Florida marketplace and now with the circumstances what they are. Before I turn it over to our friends at AM Best, we have a special relationship with AM Best. We've had a subscription with them for several years that allows us to host events like this. We get their insight, we get their perspective. They are, a greatly trusted financial analyst that gives us some information that we are happy to be able to share with you. As you all know, they don't follow they just don't review many of these Florida domestic carriers that comprise our private residential marketplace. So, these are not carriers that they have issued a rating for, but of course they know a lot about our marketplace and do monitor these companies. So we're going to get their perspective. Yesterday, and it's on our website now, Dave Newell posted it shortly before this webinar. Demotech did give, it's either 12 or 13. I have such a hard time keeping the logic straight with Demotech, but in any event, 12 or 13 letters to CEOs of Florida property carriers indicating they were going to be downgraded to an S. Now, it's not imminent. And again, the gamesmanship with how these words are said or expressed on a page is mind-boggling at times. But I do know that these carriers received notice from Demotech that they were going to be downgraded unless they took additional steps to shore up their balance sheet and be pleasing to whatever demand Demotech is making of them. There are carriers that, of those 13, that are indeed in the process of pushing up additional capital or whatever it is that they need to do to maintain their Demotech A rating. But by the end of this month, if you believe that deadline by Demotech, by the end of this month, Demotech says that they are going to issue those downgrades if indeed they are warranted among these 13 carriers. The other 33 carriers were affirmed. They got their A rating. They are as they were. And so, once again, we have this drama sort of unfolding with what Demotech will ultimately do and how it will impact our marketplace. And, we answer so many questions about this all the time, and all the agents want to know who's on the list. Well, we're tired of, trying to guess at it. And these carriers got the letter. That's a fact. And in that article that you will see that Demotech, I think, didn't really expect or want to be published by this group called the Insurer. Those carriers are identified, the ones that were not affirmed. Again, there's explanations around some of them, and they're given in that article. So read that carefully. Not everybody on that list is about to be downgraded or fail. That's not true, but they are in the crosshairs of potentially getting downgraded unless they take some actions. And again, a few of those actions are explained in the article. So with that, I will turn it over to our friends from AM Best. We're glad to have them. I'm going to turn it over to Michelle and let her introduce her colleagues for today's presentation. Michelle, take it away.
Sure. Good morning, everybody. I'm Michelle Burkott. I am a director for AM Best. I follow predominantly among my analysts the regional and local insurers. Chris, who is on the line, he is our Florida specialist and does have a handful of the ones that we do rate. In addition to the market, we also follow the billing companies Northwest, then gatherings of companies throughout the country. So I've been with AM Best for about 16 or so years. They've been in the industry for about 25. So Chris Draghi would be leading the original dialogue, the senior financial analyst here. And again, his specialty does include the market of the Florida companies. David Blades, who is also here, he's an associate director. He, formerly a rating analyst, he is now in the industry research group. And so he is still on top of all the issues that are impacting this more from a research perspective, but also familiar with many of the companies as well.
Okay, so this is Chris Draghi. Thank you for the introduction, Michelle, and thank you everyone for having us here today. We're excited to share with you what we found, at least through the preliminary look at the 2019 results. What I'll do is I'll kick it off with just discussing the problems and challenges that have been facing Florida insurers, which I'm sure a lot of you are familiar with, and then David and I will look through the 2019 results, and finally Michelle will bring us through the rating process and how some of the unique characteristics of the Florida writers are considered in that rating process. So if we move to the next slide. We can go one more, thank you.
Okay.
So as we all know, the Florida market has been facing challenges from different fronts. I'll summarize the major ones for you here, and they will become themes that drive the results as we see them throughout the presentation. One item I want to mention that is not listed is the amount of available capital within the market. However, David does have slides on contributed capital that he will discuss later. So first and foremost, one of the most inherent risks for Florida property writers are hurricanes. Insurers need to plan for them, price for them, and mitigate potential risk. Now, up until 2016, Florida had experienced a long period of benign activity. However, since then, hurricane seasons have been more active, creating regular pressure on results and market participants. Hurricanes not only impact insurers, but the reinsurers, investors, and policyholders as well. The interconnectivity of these several issues will be discussed today and will become more evident as we go through the slides. Secondly, social inflation has become a growing buzzword within the industry and relates to social trends that are increasing the severity and frequency of losses. Most notably within Florida, this has been observed through the assignment of benefit issues that have pressured results over the past several years. For those that are not as familiar, the assignment of benefits function allows an insured to transfer his rights to collect payment to a third party. In Florida, we have seen contractors solicit the use of AOBs in order to have a greater control of the claims process and subsequently complete repair work in such a fashion that costs have been considerably inflated. I'm sorry, we don't need to advance the slides just yet. I'll get to this slide in a moment. Insurers then have the burden of challenging the repairs or paying the higher costs, leading to disputes and litigation and elevated litigation costs. Another area of social inflation is the first-party lawsuits, which is very similar to the AOB issues. However, it doesn't include a third party, as we've seen in contracts. It's more dealing with when insureds have a direct contact or link with the attorney. So elevated costs from both social inflation and even shortage of supplies for the hurricane repairs have led to a considerable amount of adverse loss further development in recent years, and we will discuss this trend in a later slide. The development does create uncertainty pertaining to the accuracy of reserves in the balance sheet, and Michelle will discuss later in the re-review process how we account for that. All this rolled into one with these aforementioned pressures have led to a considerable strain in the market and act as a reminder of the associated risks. In particular, it's a reminder to the reinsurers of how much risk they are assuming, and it has resulted in a hardening reinsurance market. A hardening market poses significant challenges to Florida insurers who strive to purchase a prudent amount of reinsurance protection while being able to profitably operate. The risk-reward cost, particularly for the level of catastrophe reinsurance, becomes a complex decision layered by the reliability of hurricane models and the level at which they want to insulate balance sheets at an affordable and prudent way. Some of the results, aside from the hardening reinsurance market, are shifting interstate and inter and intra-state risk appetites. And what I mean by that is that the insurers have told us that they have the risk appetite for particular areas within Florida have been shifting, particularly in the Tri-County area where AOBs have been more rampant. And they're also looking outside of the state to profitably diversify with uncorrelated business. And another dynamic has been rate increases. All these challenges are now manifesting themselves into rising premiums charged to the insureds as companies attempt to get rates adequately reflective of the reinsurance costs and inherent risks. The benign weather and the soft reinsurance market may have led to acceptably inadequate rates in the past, but they are not becoming acceptable now. So moving on to the following slide, we'll circle back to the AOB issue. I found this slide is from the Insurance Information Institute, and I thought it was very telling and just represented what had been occurring in the previous 5-year period prior to 2019. What we see happening is that the AOB lawsuits were dramatically increasing from 2013 to 2018, increasing by about 575% through that 5-year period, 2/3 of which were reported in South Florida. Our expectation is that we'll see the number come down by a modest amount in 2019 due to the mid-year reform that took place last year. And speaking of the reform, the following slide summarizes the major points of the legislation. Overall, the reform is intended to create a more equitable AOB process with greater transparency and more formalized obligations and rights outlined for the parties involved. The bills allow insurers to write AOB restricted policies for an adjusted premium. And finally, perhaps most importantly, a payment scale was established to prevent runaway litigation and curb the AOB abuse. The establishment of a system based on percent of disparity between judgment and pre-suit settlements creates a process that makes each party a bit more accountable and hopefully deters the bad actors who do not have legitimate claims. Initial indications have been good, as Citizens was quoted back in January saying that they saw a material dip in AOB lawsuits. And I know this is something that the FAA was heavily involved in, so I commend you for your efforts to getting this reform passed. And finally, just a note on what we're seeing in terms of market activity. The following slide summarizes the major mergers, acquisitions, liquidations that we've been seeing come through. The challenges, of course, have not been without its casualties, but have also created opportunities for others. There have been several major transactions announced, including the liquidation of Windhaven and Florida Specialty, and acquisitions announced, which include Anchor Specialty, Centauri, and Prepared Insurance. Unsurprisingly, you will see several of these companies listed come up on the following slides, where we attempt to identify those insurers who have been particularly challenged by the current environment. And with that, we will jump into the 2019 results, and I'll turn it over to David, who will discuss our initial findings.
Okay, thanks, Chris. Good morning, everyone. Again, my name is David Blades. I'm an Associate Director here with AM Best. What we want to do over the next few slides is kind of find out how everything that Chris laid out in terms of the challenges, how that all translates into the financial results produced by Florida domiciled companies. So over the next several slides, we prepared a number of exhibits that we hope help illustrate the shifting market and operating pressure that many of these companies are facing. Now, first, before we get into the 2019 results, I just want to clarify sort of the population that we looked at in order to aggregate some of the results that you'll see in the coming slides. For the purposes of this specific presentation, what we did was we came up with a population of Florida domiciled companies that fit into AM Best's predominating personal property composite. And our personal property composite basically consists of those companies where more than 50% of their direct premium written volume is comprised of homeowners insurance, farm owners, auto physical damage, and fire insurance. So again, what we're looking at is the Florida domiciled companies that fit that description. And in that way, what we're hoping to do is highlight the Florida property specific companies so that the results of those companies, again, best illustrating the challenges that they're facing, can kind of be highlighted and illuminated, and we can kind of get some takeaways from looking at them. So we can forward to the next slide. Okay, this first slide here is our listing of Florida domiciled, again, personal property companies. What we did is we put together a top 20 ranking of these companies, and again, mentioning that they are Florida domiciled companies, have to point out that larger participants such as AIG's Lexington Insurance Company and Chubb's Federal Insurance Company aren't included on this list. But again, this is focused specifically on Florida domiciled companies. And I also have to say that specific to this region, Citizens Property Insurance Corporation, their results aren't included in most of these results. There are a couple of slides where we do include Citizens, but because Citizens has not filed yet their statement for 2019, we couldn't come up with these results aggregated through the 2019 year and include Citizens. So for consistency purposes, they aren't included in this list. But you can see that the list again shows the top 20 writers, and they're ranked by Florida property premium and the property lines that we included, and you can see them in the third and fourth columns are the homeowners multi-peril and also the fire and allied lines of coverage. And allied lines just mean those that are sort of attendant to fire coverage, windstorm, hail, and any resultant damage from smoke and water. So that's kind of what we looked at to rank these companies from a top 20 basis. And you can see, looking at the list, Universal Property and Casualty, State Farm Florida, Heritage Property Casualty, FedNat are the top of this list. What you'll also note in the next to last column, where we show the Florida property premium as a percentage of each company's total premium, is that you'll also see in there that the Florida business accounts for the lion's share of these companies' business, with one or two exceptions in this list. So again, this is really kind of focused on Florida-only companies, and you can see that in that next last column. And in the final column, where we highlight the net loss and loss adjustment expense ratio, barely kind of the takeaway from there is you can see that this is just a wide variance in terms of those ratios there, meaning that obviously for the companies that you see, and there are 4 of them that posted net loss and LAE ratios in excess of 100, meaning that they suffered an underwriting loss on their Florida property business, even before accounting for underwriting expenses, which would obviously only deepen their losses. So you can see there are a number of companies that, had, fairly decent results, but there are also those that were hit very hard by their underwriting of Florida property business. So we can then go on to the next slide. And this slide is really focused on the aggregate, so aggregated combined ratio for these companies. Basically, a company's combined ratio is a combination of their loss ratio. So again, the premiums they take in, the losses that they incur relative to the premiums they take in, and also their underwriting expense ratio. And it's an indicator of their overall underwriting performance. A ratio under 100 is generally considered profitable. So as you can see in this slide, over the past 3 years, in the aggregate, again, for that list of Florida and domiciled property writers, the companies have reported, collective combined ratio, over 100. So 2017 and 2018, we know how, how heavily impacted those couple of years were from the standpoint of catastrophes and hurricane activity. But also, these results reflect also the pressures from, as Chris mentioned earlier, social inflation, and also the impact from adverse loss reserve development, where companies will initially reserve for the claims that they have on their books. And then over time, we've seen that, that those initial reserves in a lot of cases needed to be fortified or increased, because the initial view of how much the companies would have to pay for those claims increased over time as they got more information on those claims and as they incurred more loss adjustment expense as well. And like I said, so you can see also, we'll point out the increase, specifically the stark increase from 2015 to 2016. That increase in the combined ratio was in part driven by the rise in AOB issues within the state. So again, as AOB issues really began to come on the forefront, you can see how that impact was first really felt in the market from 2015 to 2016. All right. And so with that said, it's also noting that it's worth noting that if we actually took a straight average of the combined ratios of each of the individual companies based on their reported results, that average combined ratio would actually be higher than what you're seeing, let's say for 2019, the 104.2. So doing this on an aggregated basis, what we're doing is aggregating the individual components of the combined ratio, their premiums earned, their losses, and their underwriting expenses. But if we just looked at what each company has posted for their own averages, the combined ratio actually on an average basis would be higher. And that's something that's, again, telling in terms of what the individual companies are dealing with in the marketplace. So we can go on to the next slide, slide 12. And this slide, and again, is a 3-year look at the results. And again, we're ranking by the highest combined ratio and focusing specifically on the 2019 combined ratio for the ranking. And again, you can look, we've again accumulated a list of those companies that reported the highest combined ratios. And again, again, by and large, again, the combined ratios have been well above that aggregate average that we showed on the previous slide, where the average combined ratio of each of the last 3 years has been about 104. When you look, at the combined ratios being posted by these particular companies, again, they're well above the aggregate average. So again, what that shows is for everybody, when you throw everybody into the pot, this speaks to how well that some of the better performers are helping that overall aggregate combined ratio when you look at some of these companies that are suffering the worst and looking at some of the combined ratios that they have been posting. All right, and again, there are within these numbers some statistical anomalies. I'll point out maybe one or two. Again, if you look at the 2017 results for, let's say, Vault Reciprocal Exchange, which is halfway down. Again, that company only started doing business in the 4th quarter of that year. So basically, they really didn't report much premium at all, but they incurred expenses in that last quarter to get things going. So again, that created some just skewing of their numbers, and there are from time to time that you can also see anomalies in some other numbers, but in general, these numbers and most high combined ratios really do show what some of these individual companies have been dealing with, and how much pain some of them have felt in the last few years in writing this business. And again, that's just a reflection of the challenges that Chris mentioned in some of the opening slides. All right, we can go on to the next slide. Slide 13, if we can. So, Dave, you still there? If we could advance one slide ahead. Okay, thank you. All right, so the aggregate, just the loss and loss adjustment expense ratio. And this is one of the exhibits here where we included, a comparison of results with and without Citizens to look at this overall aggregated results of those Florida personal property riders we spoke of earlier. So again, the majority of the slides do not include Citizens information, but we populated this one in order to show the impact that Citizens has. So if we look at this, so from left to right, and we're going from 2015 to 2019, the 2019 results obviously do not have Citizens included because they haven't filed, or we haven't received their filing yet. But if we go each of the succeeding 4 years, you can see that the results without Citizens, which is the blue bar, obviously those results are a little bit better in each of those years, and sizably better than the results with Citizens included. So it just shows the deterioration when you include Citizens, and I think that's an indication of the quality of the risk that this insurer of last resort is taking on. So again, I think it's it's pretty telling that obviously the market in and of itself, all the personal property writers are dealing with challenges, but when you bring Citizens into it, you can just see the impact that it has. And again, we know 2017 and 2018 in particular were tough years from hurricane activity, but even in some of the earlier years that might not have been impacted as much, you can still see a difference in terms of how the Florida property domicile companies perform with and without Citizens included. Okay, we can go on to the next slide. Okay, and what we tried to do is for individual companies, we wanted to rank these companies by the largest individual change in their 2018 to 2019 net loss and loss adjustment expense ratio, and kind of see the variance from that standpoint. So I have to point out the first thing that kind of jumps off the first company listed here, Olympus Insurance Company. Basically, looking at their statement for this year, basically in 2018, their premiums, their reported earned premiums were about 5.4 million, and that went down in 2019 to under $1 million, about 876,000. So we see a company whose results are impacted by premiums that are declining, but then you look at their losses incurred, and their losses incurred, which were about 10.5 million in 2018, jumped up to just under 20 million in 2019. So again, those numbers are skewed, and you can see that's what kind of vaults them up to the top of this list, is because obviously some of the pressures and some of the volatility that's just specifically going on within that company, and again, it's pretty that's pretty stark in terms of premiums declining from year to year, and also incurred losses. So again, that's led to the outsized net loss and LAE ratio that we see from that standpoint. But again, you can still you still look at a number of companies that from year to year, and again, this slide really speaks to the volatility in the marketplace that Florida domiciled and Florida focused property insurers have to deal with, is that when you look at the year-over-year change from one year to the other in their loss ratio, it's really stark in a number of cases, especially those top companies on this list. So you can just see this is the challenge that from year to year these companies are faced with, and it's it's something that we as AM Best we continue to look at in terms of how we rate them, how we look at their operating performance for the rated companies, and it's just something we definitely keep an eye on, and we can continue to keep an eye on as we move forward. All right, we can go to the next slide. All right, now we're looking to gain a little more insight into the loss trends for the Florida property insurance by kind of tracking maybe how AOB issues have impacted results, and to do so we've developed this specific exhibit where we strip out the defense and cost containment expenses, which often include things that obviously help from a litigation perspective, whether it's utilizing in-house counsel or any of those expenses used to try and contain contain those expenses. And what we looked at is examining this trend over the last few years. And what you can see is from 2014 to 2018 in particular, costs rose very sharply from those defense and cost containment expenses, making up 1.6% of the aggregate earned premium of these companies to 4.2%, as we look at it at the end in 2018. Now in 2019, we did see, for right now, and again, all of this data is based on what we've aggregated to this point. I think we cut off everything as of this past Tuesday, which was the 17th. So there still might be some data coming in. Obviously, companies have to file their year-end statements as of March 1st. And so we are, and luckily the three of us here don't have to do it, but our statistical processing folks who really are champions at this time of the year, who aggregate all of the information from all of our rated companies and the data we get on our unrated companies, they've put this information together. So looking at 2019 to this point, we see that the DCC ratios declined to 3.2%. But again, you still see the trend over time where we've seen, again, what we feel is the impact of some of the AOB issues and some of the other things that we've talked about. And I said it's, again, largely, we've seen a pretty stark increase and a pretty stark impact from those issues. And again, we do think that drop in 2019 in part could be due to improvement. It's likely impacted from the benefit of impact of reforms that were passed in July of 2019. So again, we'll see when all of our final numbers are in, but right now it does look like there was some impact, positive impact in 2019 from that standpoint. Okay, we can move on to the next slide. Okay, and as Chris mentioned earlier, we're trying to look, we also want to look at overall the aggregate surplus, the aggregate policyholder surplus, to kind of look at some balance sheet related impacts of the challenges that companies are facing in this marketplace and what it's done to them from a balance sheet perspective. When we've looked at the loss ratio and the combined ratio, we've really been talking about things hitting them from an underwriting or operating standpoint in terms of the income they're creating. But from a balance sheet perspective, looking at how it's impacted the group of companies in the aggregate from a balance sheet perspective, over the past 10 years, what we can see is that the aggregate policyholder surplus has grown considerably. When you look at the 2011 to 2014 years in particular, and in those years, they're really relatively benign years from a Florida standpoint, from a storm perspective. So I think that's where we've seen sort of the upward trend there. And then we've kind of seen that plateau, as you see over the last few years, and even on a very, very modest year-to-year basis, we've seen the overall surplus trending a little bit downward over the last years. Now, it's telling that when you look at 2017 and 2018 in particular, so when you go from 2016 to 2017 and then 2017 to 2018, knowing how those years were impacted from a hurricane perspective, you would normally have expected that decline to maybe have been more severe. But what we've seen is that insurers are, one, benefiting from they're probably retaining lower levels of these overall losses by transferring the bulk of some of this business to their reinsurance partners. And we've seen that's insulated the balance sheet impact somewhat from these storm-laden years. And also, It's also impacting, I think we'll actually see from the next slide, material capital contributions that parent companies have put into some of these insurers has also helped flatten out the surplus in the last few years, even with the impact of the very tough 2017 and 2018 years. So we can actually talk about this a little more going ahead to the next slide. Okay, and again, what our focus was here on looking at these last 4 years was the aggregate and contributed capital, over the year, and then kind of juxtaposing that next to the overall change in surplus. So what you can see in the blue, in the blue bars where you're looking at contributed capital in those years, when you look at 2017 and 2018 in particular, the fact that the change in surplus is obviously negative, but you can see how much worse it would have been if, when you're looking at the blue bar, if there was, or if these companies didn't benefit from contributed capital in those years. So in particular, you can see that had a big impact in 2018, and you can see, even in 2019, again, it's having the same effect. So 2017 through 2019, again, as companies have dealt with results that have hurt their overall bottom line and had some impact on their balance sheet, that impact has been muted by the capital contributions that they have enjoyed, and again, that has overall flattened out the aggregate surplus level for these companies. Like I said, that's if without these contributions, surplus would have actually declined by $1 billion, or roughly 20% from 2016 through 2019, as opposed to the actual reported about 186 million decline. So when you consider that, it's a huge impact from a balance sheet perspective. Again, in the aggregate, that contributed capital has had on these Florida domiciled property rights. We can move ahead to the next slide. And again, what we're showing here, last two slides, we kind of looked at things in the aggregate. This slide kind of focuses on the top insurers ranked by capital contributions. And again, we're looking at it by that last column, we've ranked them by the contributed capital total over these years, so 2015 to 2019. Again, what you see is, with this list of companies that have received the largest amounts of capital contribution in the last 5 years, unsurprisingly, it lists a number of companies that are members of larger corporations where funds are more readily available, such as, ASI, for example, the first company there. But, we also want to point out that companies such as Security First, Anchor, Property Casualty, and Prepared Insurance Company aren't part of larger national corporations. So those companies too have benefited from capital contributions. And I guess it's interesting enough that two of those three companies that I just mentioned actually have recently announced that they would be acquired. So the takeaway from this slide, again, and from the last three slides, is that capital contributions have had a sizable impact in terms of muting the effect that the results of the last 3 years, and again, companies have felt those effects on their income statements in terms of their underwriting losses and overall operating losses, but the impact of that on their balance sheets has been muted by these capital contributions. So with that, we can move ahead. I think Chris will take back over on slide 19 as we transition into some other looks at the aggregated results of these companies.
Thank you, David. So partly pressuring operating results surplus growth has been the rising reinsurance costs that we've noted, or I noted earlier in the presentation. As many of you know, Florida insurers generally purchase prudent catastrophe reinsurance programs given the hurricane risk within the state, and it comes with no surprise that the cost has a material impact. In this slide, we've trended the unaffiliated ceded written premium. As we can see, the ceded premium has been increasing year over year with a sharper incline in 2019. This validates the hardening reinsurance market, which became more evident more recently in 2019. Reinsurers have adjusted their risk appetite for Florida exposures given the recent challenges from hurricanes, social inflation, and adverse development, charging more for the same level of protection. Furthermore, the considerable amount of losses assumed by reinsurers from the recent hurricanes have acted as a stark reminder of the severe impact these events can have. Now, rising reinsurance costs create complex decisions for insurers. First, they need to decide if they will attempt to purchase the same level of reinsurance as they've done in the past. If they do, this will come at a greater cost and negatively impact earnings. If they decide to reduce coverage, it may reduce costs or keep them somewhat consistent, but put more capital at risk. This, in turn, could prompt insurers to reduce their exposure in certain high-risk areas to mitigate the potential losses from events and better manage the probable maximal loss. More thinly capitalized companies may be more challenged in this environment. Moving to the next slide, within our review process, we look at a company's reinsurance dependency to gauge the level of reliance they have on these reinsurers to provide funds to settle losses. In this particular slide, we've used the metric of the unaffiliated ceded premium over policyholder surplus. Given the need for Florida insurers to purchase prudent catastrophe programs to match the elevated hurricane risk, which comes at the high cost, as I discussed, we expect Florida insurers to have an elevated level of dependency. So when we ran this model, we did not expect to see low leverage amounts. However, what's telling is that the aggregate average for dependency has been trending up considerably, starting at the 131.6 in 2015, ending at a 192.4 in 2019. The greater dependency indicates a greater reliance on third parties to protect the insurer's capital position. If we take another look at it on the following slide, we broke it down by individual company, as was the case in the previous slides. The aggregate often skews some of the results, given that there are players within the market that have substantially higher leverages. You'll see on the right side with that same metric, we have carriers that have basically multiples of the 192 that I just quoted on the slide beforehand. But this slide also introduces another form of dependency that we look at, or another metric, I should say, the unaffiliated ceded premium written over gross premium written. This is essentially showing how much the gross is ceded out to acquire its reinsurance protection. And this list of the top 15 was, as we noted them here, all of them cede out more than half of their gross written premium to pay for their protection. These companies are identified as being more sensitive to the hardening reinsurance market, who will likely face considerable pressure and challenging risk-based capital decisions. Unsurprisingly, we see the companies who I mentioned earlier in my mergers acquisition list show up on this list, such as Centauri, Prepared Insurance, Anchor. So this is a telling slide to see that who among those Florida market writers are facing some considerable pressure in today's environment. Advancing to the next slide, this slide here, as I mentioned, loss reserve development has played a role in the hardening reinsurance market, and this exhibit helps illustrate why. First, let's look at the trend. Back in 2014, development was favorable, but since then, the redundant position reduced until aggregate reserves started to become more deficient in 2017. What was driving this? Well, prior to the hurricanes occurring, social inflation via the AOB lawsuits had been on the rise, leading to an unexpected increase in the severity of water claims that insurers had not adequately reserved for. This accounts for the reducing redundancy levels even before hurricanes occurred. Then once the hurricanes came through, it exacerbated social inflation climate, which led to profound adverse loss development known as loss creep in 2018 and 2019. Albeit the situation was further worsened from what companies have communicated to us as a lack of supply, particularly as it pertained to the tile roof replacements. Often exact matches could not be found, which resulted in a complete overhaul of the roof. So how does this affect the reinsurance pricing? By and large, the considerable amount of adverse hurricane development driving the 2018 and 2019 results was ceded to the reinsurers, as primary carriers had already breached their retention limits, as David noted earlier. So this unexpected development led reinsurers to shift their risk appetite and has prompted the hardening market. So what other factors have we seen come through with these challenges in the market? On the next slide, we just took a look at the policies in force for Citizens Property Insurance Corporation, wondering how that looks now, because considering for starters, since 2012, the depopulation program of Citizens have been fairly successful. With all the noise in the market, we wanted to track to see if some of this may be coming undone due to the changing shifts in risk appetite and stricter underwriting guidelines becoming more apparent. And what we do see is an uptick in Q4 of 2019 with this jump in the personal residential PIP over at Citizens. Now, it's very early to say that this is a complete reversion, but it is something that we will monitor going forward. Advancing one more slide is obviously what I mentioned, the rate increases. What's happening here is that all the challenges that insurers are facing are trickling down to the insureds via higher premiums that are being requested. Multiple companies have requested double-digit rate increases. Anything over 15%, as you may know, requires a hearing. We see here the three most recent ones that I was able to acquire range between 21.9% and 36.5%. And these sizable increases are all intended to offset the rising reinsurance costs, as well as more adequately price for the inherent risks involved in these policies, given the social inflation and hurricane environment that has become more apparent. And then finally, going to the legislative update, I'm sorry. If we can go one more slide. This slide we had kept in here as a placeholder as session was being held. And I decided not to take it out just because I thought it'd be important at least to show what was being discussed in terms of any potential reform. Most notably here is Senate Bill 914, which looks to limit attorney fees by tempering the risk contingency multipliers, which is directly addressing the first party lawsuits, which have been problematic that I noted before as another form of social inflation that have negatively impacted the market. We expect these to remain a hot topic, and it may take time for reform to come through, as we saw with the AOB reform. But with that, I'd like to turn it over to Michelle, who will walk us through the rating process and how these unique Florida qualities factor in.
Hey, Chris and David, before we move on, let's try to clarify a few things of questions that have come in from the members before we move on to the rating process presentation by Michelle. You guys okay with that?
No problem. Yep.
All right. So one question that came in to clarify the aggregate combined ratio. It's losses they incur relative to the premium they take in plus management expense. Under 100 is profitable. Can you just kind of explain that ratio again?
Okay, so yes, when the combined ratio, and again, that's one of our key ratios that we look at when we judge companies' operating performance. The first component of that, as you said, Dave, is their loss ratio, and that loss and loss adjustment expense ratio. So what we're looking at is for the premiums that each company earns look at it from a calendar year basis. So for whatever year, 2019, we look at the premiums they earn, and you also look at the losses that they incur during that year, plus not just the loss payments from an indemnification standpoint, but also the loss adjustment expenses that they have to pay, again, in court costs and attorney costs, any of those types of things that are allocated specifically to an individual claim. You add the actual loss settlement or loss payments, plus those loss adjustment expenses, and that gives you your overall loss and loss adjustment expense ratio. You then combine with that their underwriting expense ratio, and underwriting expenses, for some lines of business, large component of that is the acquisition cost, the cost that they pay out to their agents or their brokers in order to acquire the business that they're writing. But there are also other underwriting expenses just for the companies as they allocate their overall expenses just in running their operations, just running their overall underwriting operations. So you combine their, again, the acquisition costs with the other underwriting expenses, and combine that with and come up with an overall underwriting expense ratio, and that's compared to their that ratio is underwriting expenses on the top and then net premiums written on the bottom. So you get the loss ratio plus the expense ratio. That overall gives you a combined ratio. And again, a combined ratio of more than 100 means that generally for every premium dollar that you take in, you're paying out more than that $1 in losses and expenses that are going out. If you have a loss ratio, let's say of 90%, then for every premium dollar you take in, you're only paying out in losses and expenses 90 cents on that dollar. So again, you're making a margin there of 10 cents for each of those earned premium dollars. So again, what we look at is the operating performance, and we'll look at from an overall perspective, in order to understand how companies of similar type or that face similar challenges are doing, that's why we kind of looked at this particular composite of Florida domiciled personal property companies, so that when we're comparing, it's kind of comparing like companies that might be writing similar portfolios of business. And then when you look at their combined ratios, you can see which companies, you can just have a better reference point to, when you're trying to judge which companies are doing well and which companies aren't doing as well. But again, that, if you want to look at it, that 1.00, that 100, threshold from the standpoint of looking at how much you're paying out in losses and expenses to how much you're taking in, that's really what we look at in the overall from the combined ratio perspective.
And maybe just to add just one comment on that. So if you think about it from a income statement perspective, if you have a combined ratio of 100, you should really be break even on an underwriting income basis.
So Dave, one clarifying comment there. This is Jeff Grady. Something that does distinguish these companies is how they buy reinsurance. For instance, some buy it on a quota share and they cede a huge portion of their premium, and the way that it's reported causes some of those results to look odd. If you notice in some of those slides, Olympus was one of those companies that just have, almost outrageous looking numbers. That's not true. Actually, Olympus is one of the companies that got their rating affirmed by Demotech recently, and their results are better than their peers in terms. So sometimes the way that this comes up can look very odd. That's not necessarily the story. What I think AM Best is telling us is, as a whole, this industry has some serious problems, and the numbers show it. But don't get lost sometimes when the numbers look like huge outliers. That can be because of the way they buy their reinsurance.
That's very true.
So if they are ceding a significant amount of their premium, again, I think to David's point earlier, their denominator is significantly influenced. So again, they could have that much lower premium, which distorts, the overall ratios.
And to elaborate a little bit more, is that's a strategic move by some companies in order to earn ceding commissions and make money in a different way.
Okay, well, I think we've addressed most of the questions based on those comments. So, Michelle, you want to take it on to the next slide, talk about the rating process?
Sure, and maybe just to start on slide 28. And again, I think, my colleagues have done a good job in terms of just describing the challenges of this market and the, the end result and some of the ratios that we've seen. But, AM Best, as you know, we've been around for over 100 years. We are focused solely on the insurance market, and we have, global ratings across, various countries. I think, our analysts, we have very tenured analysts. On average 6 years plus 17 years total industry experience, and we do promote professional designations. So even as we created this associate analyst program where we do take in recent graduates, we definitely push them, to continue professional designations with CFAs, FRM, CPAs, as well as CPCUs. And then we do have, an actuarial track as well for many of the analysts here. So with that in mind, we thought it would be a good idea, just again, to maybe refresh everybody in terms of how we look at companies and what our rating process is. But we do have that interactive approach, and I think that's really helpful in terms of, working with management teams in terms of getting every bit of information we need, as well as the follow-up. Our ratings are based, we always focus on that financial strength. So we look at, not just the balance sheet, but we look at operating performance, business profile, and ERM. And I think one of the things we did want to highlight is that, as I mentioned, Chris follows the Florida market. Right now, those companies that we do have ratings on in that market, they are acceptable by Fannie Mae and Freddie Mac right now in terms of the rating levels. So if we jump, okay, actually, I just want to have Chris jump in for a second. Oh, sorry. Okay, so if we jump to slide 30, and this is our building block approach, and we did switch our methodology a little over 2 years ago now. And what we're trying to do is really become more transparent in the market in terms of how we develop our ratings. So I think if you start on the balance sheet strength, as we call them, the building blocks, this is where we really have the starting point. We look at our BCAR scores, so we're trying to measure the risk-adjusted capitalization. But as we've always said, BCAR does not equal your rating. I think what's important in this slide as well is that BCAR does not equal your balance sheet strength either. So besides BCAR, we're also looking at things such as stress tests. So in the, from a BCAR and a balance sheet point of view, one of the stress tests we do, which is important to this market, is for natural cat. So, if you think of hurricanes, we do require the companies that we rate to supply us with their PML information, both on a gross basis as well as on a net basis. And we look at that across our value at risk levels. So we are looking at it from, the 1 in 100-year event, 1 in 200-year event, 1 in 250, and then outwards. So, based on those stress tests for that, we do have different categories in terms of how much tolerance we have for their BCAR score. I think some of the other things in terms of this balance sheet component, we look at liquidity, and this, in this current state of market, this is particularly important, as well as asset liability matching. So again, are your cash flows sufficient to support the claims that are coming in? We look at if companies are doing any of their own capital models, again, trying to not just on a BCAR basis, but also on their own basis, how do they get comfortable with the level of capital that they hold? We look at quality of capital here, is there any, is it made up of surplus notes? Is it made up of other debt obligations, which could pressure earnings in terms of supporting those, or could it pressure in terms of not having sufficient liquidity? I think, both David and Chris did a good job in terms of looking at, the reinsurance and the dependence. So I think this is important as companies do, especially in this market, have a high level of reinsurance dependence because of the, the hurricane activity and the cat exposures that they face. We do monitor, are they using quality reinsurance? Have they developed, more formal structures in terms of, is it a quota share? Is it a cat ag? Is it a combination of many different structures so that they have protection both for the frequency of events as well as the severity? And then again, financial flexibility here. Do they have holding companies? Do they have other sources of access to capital should an event happen and they need to replenish in a short amount of time? So if we jump over to, actually, no, you know what? The one thing I did want to mention before we get off the slide, just in terms of the companies that we rate, and we do start them. We do have companies that, we have very strong, and some that we rate have weak in terms of the balance sheet trend, and I think that's important.
If I can add too, in this section, we do review the loss reserve development. So we'll look at the adequacy of the reserves as they presented to us on the balance sheet strength and consider independent actuarial opinions and their claims reserving process to get comfortable where they are. And if in the case that we feel like reserves may be a little understated, we do apply some risk charges within our BCAR to capture that risk.
I think what goes hand in hand with that too is that one of the charts shown earlier in terms of just the aggregate surplus. I mean, we look at surplus growth too, and this is an important component of the balance sheet strength. So if you are eroding more of your capital year over year, obviously that is a very big negative pressure in terms of the balance sheet strength. So if we want to jump to slide 31, this would be our second building block, operating performance. And again, we're looking at a lot of things. I think, one of the critical things that we've seen recently is we have noticed a lot more volatility. Again, not just based on hurricane activity, but also AOB issues, which has created some of that, social inflation and pressures on reserve development. So while we look at reserve development in the balance sheet building block, obviously it has an influence on terms of your operating performance as well. If you're strengthening your reserves, your loss incurred is going up to reflect that, which would mean your overall performance is going down. But we're also looking at other trends in terms of, some of the things that were highlighted earlier in terms of your expense ratio, loss ratio, combined ratio. What are those doing? Return measures, pre-tax return on revenue, pre-tax return on surplus. So one of the things too we're looking at for the companies that we rate, your financial forecast or plans. So not just, looking in the back rearview mirror in terms of what have you done, but really over the next 12 to 24 months, what are you anticipating? Again, and is that a realistic view in terms of, loss activity? In particular, we have that focus on near-term CAT activity. So we want to make sure that those risks are being properly viewed by management teams for the companies that we rate. If we jump to the next slide, for business profile, here for every Florida writer that we have a rating on that is focused on property, we do have that limited assessment, which would be that -1. Up top you can see that we go up +2 or -2, but for the Florida market specifically, we do have them as limited -1. And again, it's a function of the market that they're operating in. It is, concentrated in terms of, the business is concentrated in terms of what level of exposures they have. Again, that natural CAT is significant. Some of the other things in terms of what we are seeing, all companies, not just Florida, is really enhanced ability in terms of pricing sophistication and data quality. So, as companies have, revamped their policy administration services, their agency management platforms, things of that nature, the quality of, and the timeliness of what they can get and sharing that information. Ease of doing business is critical. And I think in terms of, more, not just Florida, but more companies and more agents are definitely working together so that they know that they can, streamline that process and make it more efficient. Other things that I just want to touch on, management quality is here as one of the components of the profile. And I think back to my earlier point in terms of actually looking at financial results compared to financial plans. Is it a company that has, kind of laid out results and met them? Or is it a company that lays out results that are maybe a bit too optimistic year over year and then does not meet them? So that's kind of one of the things we would look at. Regulatory event risk, this is really important, especially in Florida. I think Chris identified some of the things we're watching, you're watching. Really not a lot has passed other than that AOB reform in July of 2019, but it does have a big impact on a market like this. So we are actively monitoring that as well. And then distribution channels. I mean, most of the companies that we're following do have that, very important relationship with their agencies. But again, we do see some companies just kind of taking a wait and see approach to see, with the changing customer demands, is there another option that would also benefit the agents, but also benefit more of an online type of access to the market. If we want to just highlight innovation on this one, this was our newest category that we added to business profile. And, we've had a lot of public commentary in terms of what we're expecting. Here, we're just trying to find out for those companies, that are in a market where there is a lot of innovation going on, to make sure they're not falling behind. Is there anything that they're doing that definitely will make them more efficient or make them more marketable or make them, increase their presence in the market? So when a lot of people always think of innovation equals technology, sometimes that's the case, but it could be innovation in a product. It could be innovation in getting to your agent closer, quicker, and better. So really, innovation is kind of in the eyes of the beholder when it comes to what's important to each specific company. If we want to jump to slide 33, here, ERM, Enterprise Risk Management, we've been asking companies for this for a very long time. When we initially came out with our building blocks, this particular assessment, over 90% of the market was viewed as appropriate, which would be that 0 ERM. And I think what's important is that, as risks continue to emerge and as the market changes, we say that companies need to continue earning that 0 for ERM to make sure that what they're doing in place in terms of governance, systems, managing their risks continue to, grow and expand and evolve, so they're not, missing things that are now, on the front of what is what is the upcoming risks. What's important on this slide too is we have stress testing, and although we talked about stress testing and balance sheet strength as relates to Nat Cat, stress testing here is more a component of how they're looking at their risks to make sure that they have enough capital. So this could be a combination of catastrophe events. This could be definitely a spike or a decline, as we're seeing right now in terms of equity markets. Whatever is important in terms of one of their greatest risks, we want to make sure companies are monitoring this, and then also stressing within a realistic expectation so that they know at the end of the day what impact it could have. So are they measuring that? Is there a tolerance? Based on their stress testing, do they want to, not lose more than an X% of their income? Do they want to not lose more than a certain component of their surplus? Or again, for those that we do rate, is it a function of how much of a drop in the car that it could possibly measure? So I think too is that, as we look at our ratings, and I know the commentary earlier in terms of, some of the participants are, wondering what Demotech's going to do. I think as we look at our ratings, and again, it's a small population for this market, we do it over a longer time period. So you won't see quarter to quarter adjustments in our ratings. We look at the trends, and we look at, what companies are doing to continue that performance metric or to continue that profile. And you won't see typically, back and forth, up and down ratings. It's just not part of our methodology. So I think that highlights our process. I know I kind of went through that quickly, but if anybody has any questions, I'd be happy to answer them.
Well, thanks, Michelle. And folks, we're past our hour. Certainly, we have several questions. Michelle, we'll just go ahead and get with you guys offline, and as we normally do. And just a reminder, we have recorded this. We're going to get with Agatha, our Director of Communications, and we'll have this posted. AM Best has been kind enough to allow us to share the slides as well. So we'll have those in a prominent spot on our website. And certainly the questions that some are asking, we'll get those answered with an FAQ and provide those as well. So everybody that attended today and those in the future can have the answers to some of those questions. So I want to thank Michelle and David and Chris for being part of this presentation today from AM Best. And before we go, Jeff, any parting words from you, from your perspective?
No, those questions, though, if you have them, Dave, once this session is over, they can no longer ask them. So where should they send them, to you or to me?
Yeah, go ahead and just send them to classroom@faia.com. Classroom@faia.com. We'll get them and we'll answer those as well. So when you're offline, if you think of some things, send them to the Classroom website, and it's monitored all the time, and we'll get those questions answered as well.
Thanks.
All right, folks, thanks. Be safe out there. Enjoy the rest of your day. Appreciate the time this morning, and thanks our friends from AM Best. And
welcome, Dave.
Take care.
All right, thanks.
All right, thanks. Take care.